Here now with CNBC contributor and Trend Macro Chief Investment Officer Don Luskin. We also have Michael Pinto, Euro-Pacific Capital Senior Economist. Gentlemen, before we start, I want you to hear Mr. Rex Tillerson, the CEO of ExxonMobil, the most powerful oil company in the world. Take a listen to his take.
From my perspective, as things approached $4 a gallon gasoline, and as you hit $4, it was like that was the straw that broke the camel's back for many consumers, psychologically, but also managing their household budgets. You know, an extra $50 a month in gasoline cost may not sound a lot to a lot of people. For a lot of people's household budgets, that's a problem.
All right, one of the great CEOs, one of the great corporations around the world. He is raising a deflationary point, Don Luskin. So I want to ask you regarding Mr. Bill Gross's surmise that bonds are a bad place to be. He's talking about Treasury bonds. He's expecting long-term interest rates in the Treasury market to go up quite significantly. Ms. Tillerson, on the other hand, raises the issue of a slump in growth and deflation. Where do you come out, Don?
Well, I think what Tillerson's talking about is not necessarily deflation in the sense of the price level coming down. I think he's talking about the idea of a recession or a contraction being brought on by high gas prices, just a classic oil shock. What Gross is talking about is something entirely different. Gross is talking about a liquidity effect that'll happen at the end of June when the Fed stops buying treasuries. He's looking at basically a technical phenomenon. It has nothing to do with inflation or deflation. He's assuming that when that big buyer in the treasury market stops being in that market, that yields will skyrocket because no one's supporting the market. However, there is nothing supporting that belief because this is now the third time that the Fed is engaged in large-scale long-term asset purchase programs. The last two times when they terminated those programs, fixed income markets just didn't even notice. So I'm actually not worried about that.
All right, you're not worried about that. Let me ask you, Mr. Pinto, are you worried about that? Now, look, Bill Gross, a very astute investor. No one's perfect in the world, but he's basically saying there is a monetary and credit bubble. Whether there's inflation in that, I'm not sure if Gross is saying that, but he's saying get out of Treasury bonds and that their rates are going to rise. What's your take?
Well, I think Gross has it exactly right. The Treasury market is going to be overwhelmed by inflation and supply. Now, I know some people don't want to look at commodities. They want to ignore gold prices. But let's look at the pre-Luskin measurement of inflation. If you look at that, it says the CPI is now 9% year over year. That's huge. And have you looked at the ISM manufacturing survey? These respondents are saying the dollar is sending prices much higher. And they're saying they're seeing broad increases in inflation. That's not Michael Pinto. That's the ISM saying that. And how the heck can a central banker create $2 trillion worth of credit out of the blue and buy bank assets and that not depreciate the value of the dollar?
May I ask you just quickly,
end of the story. We have inflation.
All right, hang on. It's not the end of this story because we're going to get Don Luskin's point of view. But I want to ask you, Michael Pinto, if Treasury rates, which are currently about 3.5%.
On the 10-year.
On the 10-year, okay, the benchmark. If they go to 4.5% or 5%, quickly, please, what will that do to the stock market?
I think it'll send it much lower. Much lower, but they're going to 7%, not 4 or 5.
All right, so Don Luskin, now we're at a 7% 10-year Treasury that is going to decimate the stock market. Would you like to weigh in? Do you want to call? Do you want to throw a few more chips in?
Who's going to disagree that if the good tooth fairy just comes down and waves are won, and all of a sudden the 10 years at 7%, yeah, it's just going to be a stock market crash. But that's not going to happen. Even Bill Gross is only talking about treasuries going to 4%, in which case he's already missed 2/3 of the move because they were 2.5% just last August. So this is not a big deal. You know, this is a good deal. This is called growth coming back. It's 4% is a perfectly reasonable, benign, wonderful 10-year rate for an economy that finally, thank God, is growing again.
Yields higher, though, Don? It's inflation that sends yields higher. It's supply that sends yields higher. Let me just say, the February budget deficit was
asked a question.
Yeah, but I don't want to. I really don't. It was a rhetorical question. Can I answer my own question?
Luskin. No. This is a cool thing. Supply. You asked a good question. I want Don Luskin to give a good answer. Go ahead, Don.
Well, I'm not sure I really understand the question because we have. Look, I basically sympathize with what Mike is saying. I understand that the gold price signal, which I have followed all my career, has been flashing an inflationary warning. I understand that deficits have been flashing inflationary warnings. But we've got to be scientific about this. We've got to look at the inconvenient truth that these warnings have been flashing nonstop year after year after year after year, and the house just never burns down. Michael, you and I were both worried when gold sailed through 600 and 700 and 800 and 900. Now it's almost 1,500. Where's the inflation? The only place where we can find it is by making suppositions that our statistics are somehow being...
Let me go over some important data. You know, it's my opinion.
Quickly.
My opinion doesn't matter. It's not the data.
No,
the February budget deficit was $223 billion. That was more than the entire yearly deficit
When's it going to be
of 2007. Okay, the publicly traded portion of the debt has increased 95% since the end of 2006. Is there just an unending supply of savings across the globe that can be squandered into our bond market? I mean, if the Fed is just buying most of this Treasury debt, that's inflation. That's going to send yields higher.
Real quick,
supply and inflation.
Real quick, Don, your rejoinder.
Michael, when you and I were making these very same arguments with these very same words over and over for 4 years ago, 5 years ago, 6 years ago, why didn't it come true? We've got to understand the answer to that question and stop just going along with these basically religious propositions. It's obviously not really happening.
All right, so you don't think it's going to happen? You do think it's going to happen?
It absolutely will.
Rex Tillerson.